with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across this great country. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, September 19th, 2025. Some shout outs to Kevin, Don, Rich, Wayne, Carol, Carl, Lynn, all the folks coming in or touching base with us this week. We appreciate it so much. And I got to take a moment just to give a really gigantic thank you once again to all of our Delaware clients. A couple of weeks ago, we were honored to receive the Reader's Choice Award for the Delaware State News. And this past week, we received the Reader Choice Awards for the USA Today family of papers there in Delaware, all driven by clients voting for our firm. And, what a great honor. You just can't get a bigger pat on the back than that. So thank you so very much. And I've got to give a super shout out to our team. A lot of folks get up in the morning and they go to work at a job. I believe our folks get up in the morning and they go to serve a mission, and that mission is to accomplish client outcomes with a level of service that's just second to nobody. I really believe it's just the best group in the business. So big shout out to Daniel, Lisa, Jalea, Rachel, Tessa, my partner, Christina, my boss, Carol. Carol's like everybody's boss. Carol's like the boss of people that don't realize Carol's a boss. She'll call up another firm. She's like, this is what you're going to do. This is how you're going to do it, and this is when I expect it to get done. And they're like, yes, ma'am. And how about a shout out to Skipper, our CEO, our Chief Emotional Officer, because without him, we would all surely be dead from the bloodthirsty squirrels that are constantly wanting to take us out. And without him, I wouldn't even be here today, more than likely. So anyway, no, seriously, thank you all so much. My team, our clients, everything, real special time. So, hey, let's jump into the numbers. Let me tell you what's going on this week. The market pushed higher. Dow Jones up 1%, S&P up 1.2%, the NASDAQ up 2.2%, and the Russell Small Caps up 2.1%. So everything pushing a little higher this week, but something else pushing higher this week, something to go, Volatility index up 4.6% this week, even though the market pushed higher. That's interesting, and that's something to pay attention to. Another thing that was interesting this week, and we're going to talk about this in a moment, but long-term bonds dropping this week, dropping hard, dropping 1%. What does that mean? It means long-term interest rates went up. But I'm sure you heard the news. The Fed did cut rates. So why are rates going up? We'll talk about that in a moment. Look, when you look at the sectors, kind of a mixed bag. I'll just say this. A lot of the defensive areas, things like utilities and staples, they also tend to be a little bit interest rate sensitive at times. They were down. Everything else was pretty much up. And then gold was up again, 1.1%, silver up 1.8%. Again, maybe the same reason why bonds are down. We'll talk about it. So let's kind of discuss what went on this week. Jim asked a question out there on the internet. Why did the Fed cut a quarter point, 9.5? By the way, you can ask questions. You can just write info@abigplan.com, info@abigplan.com. Ask a question. I'll try to answer it. But listen, look, some of you listening are friends of mine. Info@abigplan.com does not go to my inbox. It goes to Jalea's. So behave yourselves. Don't try to be funny, asking some stupid question, okay? I know some of you guys. I know what you're going to try to do. No. Keep it clean and keep it related to the topic, okay? Don't try to be funny. But anyway, why a quarter point? Why not a half? What's going on there? So a couple of things, Jim. And look, we expected a quarter point. That's what we said last week. We thought the Fed would cut. We thought they'd cut a quarter point. They signaled it really back in August that they were ready to cut. I just didn't think the data was strong enough to warrant 0.5%. Why is that? Look, we still have 3% GDP growth. The economy is showing growth at 3%. Earnings are back into expansion mode. There's a lot going on within the economy that looks like it's hanging together, that it's still on track and that it's not rolling over yet. So the Fed just didn't feel like they had enough data to do that. And then on top of that, I'll also say this, inflation is still staying rather sticky. Like we're right under 3%. It's not like we're way down at that 2% or lower level. We're just a tick under 3%. Some of the internal metrics of these inflation numbers have been ticking a little bit higher. And the Fed is concerned if they get too aggressive here cutting rates and they let the inflation genie back out of the bottle, watch out. That's what happened back in the late 70s, early 80s. We raised rates to slow inflation because it was getting out of control, and the Fed let off the gas too soon. They cut too much too early. Inflation came back. It came back with a vengeance, and mortgages were 13% mortgages because inflation got so crazy. We don't want that to happen. The Fed doesn't want it to happen. So the Feds, and look, Powell said it, they're between a rock and a hard place. They see some of the weakening data in the economy, especially in regards to jobs. And listen, I have to tell you, I was really surprised at the market reaction this week because it was an extremely hawkish cut. And I didn't think the market would like that. And I still don't think the market will like that. I still think that maybe we're not really seeing the market's true colors just yet. I'll explain why in a moment. But it was a very hawkish cut. Fed Chair Jay Powell, he made absolutely no indication that they were fully on board with additional rate cuts. He made it seem like they were going to be exceptionally focused on the data as it continues to come out. He called it a risk management cut, like an insurance cut, but he did not sound decisive in any way, shape, or form. And when you look at the Fed as a whole and you look at the voting, it was one of the biggest train wrecks I've seen in my career on Fed decision day. It was a mess, okay? 6 Fed folks said no more cuts. They voted for no more cuts. 2 said only 1 more cut. 9 said 2 more cuts. And 1 guy said 5 more cuts. We're not even going to talk about that. There's nothing on the horizon that suggests that's necessary. And if you do something like that, you run all kinds of crazy risks for inflation and also not having any ammunition if the economy does roll over, right? 5 cuts, not really a worthy conversation at the moment. But 6 folks said they do not expect any more cuts and 2 said only 1 more. The market's got 3 priced in this year, all right, and more priced into next year. Yet it went higher. So I found that interesting. But I will say this, history has shown that when the Fed cuts interest rates in the midst of an economic expansion, the market does well looking out 12 to 18 months. Okay, I get that. But here's the question. Are we really in an economic expansion? Why did the Fed cut rates to begin with? Because jobs are tanking. They are dismal. We have horrific jobs numbers, and the Fed is getting nervous. That's why they cut. The 25 basis points, what's it going to do for anybody, Jim? Nothing. Squat. Nada. Did mortgages come down this week? No, they didn't. They went higher. They went higher because the bond market's like, hey, what are you doing? Inflation's still kind of hot here. This really doesn't look like it's time yet to cut. And the long-term bonds, they're not in agreement with the Fed. The long-term bond market is getting increasingly worried about our debt. Our debt situation is just getting out of hand. Our budget deficit is higher this year than it was last year. It was higher last year than it was the year before. It was higher the year before than it was the year before that. We are not going in the right direction in any way, shape, or form. And the long-term bond market is getting worried. I think that's also why gold went higher this week. It's why bonds went lower and rates went higher. It's why gold went higher this week. There are people that are fearful about our fiscal situation, and I understand it. But getting back to the topic, are we really in an economic expansion? I think we are, okay? I'm cautiously optimistic, but I have concerns. Look, the unemployment rate, when the unemployment rate is higher than the 36-week moving average, watch out. It tends to happen prior to recession. We've been there for a while now. The leading economic indicators, they've been negative for almost 3 years. It's never happened before. We've never had leading economic indicator index be as poor as it's been for the last 2.5 years. It was negative again this week when they announced. Earlier this year, end of last year, coming into this year, the longest yield curve inversion in United States history just corrected itself. And listen, anytime the yield curve inversion has gone on long like that in the past, which we've never gone this long, but whenever it's happened like that in the past, a recession followed, okay? Then there's other little things like corrugated cardboard, lumber. These things are collapsing right now. And of course, I mentioned jobs. Now, jobs are usually the last thing to break is the jobs market. So by the time jobs start to look pretty bad, lots of other crap is hitting the fan. I can't really say we're seeing that right now. It's almost like things are just kind of like askew and out of whack and not operating like they normally do. But guess what? This entire cycle's been that way. The whole thing's been that way because the United States federal government decided to print $6 trillion and dump them into people's bank accounts. It has screwed everything up. Every metric that usually is a telltale sign of what may be to come has missed the mark. It's why we've had to lean so heavily on market technicals, really, since COVID. Without that, we wouldn't have made anywhere near as much money as we've made at times. I mean, I remember coming into 2023, the whole world was calling for a major recession. The technicals of the market said, no, we're going higher. We got loaded up and we had a great year. My point being, a lot of the traditional indicators that economists and market participants can bank on, they're not bankable. They're not bankable because we've monkeyed with the system so much that everything is kind of out of whack. And therefore, I don't trust where we are or where we're headed fully. I just don't. I'm cautiously optimistic. Earnings are expanding. A lot of the policies that have come to fruition should be good for the economy. I think things can go higher, but I don't trust. I just don't. So what did we do? What are we doing? Well, I mentioned to you months ago that as we enter towards the end of the year, the close of the year, be on the lookout. I'm probably going to do some trimming. Look, we're having a big year. We loaded up early in April when the market was crashing, and our flagship model, the model used by most of our clients, up 22% right now. So you got to take some profit out of the market. So that's what we did this week. And we closed a position, closed Shopify. I love it. It's a great business, a really great business. But we bought it last May for $58, sold it at $147. The valuation on it's a nosebleed valuation. It's very expensive, and it's poised to take a really big hit if for some reason the market decides to roll over. We actually closed the entire position. If it goes back down to its breakout level around $80, I'll probably buy it back again. And it could get there in a couple days. That's how volatile the stock can be. So we took that profit. We trimmed back Uber. We also bought that May of 2024 when we bought Shopify. We paid $67 for it. We trimmed that this week at $98. We trimmed Citi. We bought that last August for $59. It's $102 today, right? So we had to trim that one back. CrowdStrike. We bought that last July. Our cost basis is $255. It's at $501 today. We had to trim that one. And then Alibaba. Right, we bought that November of 23. It's $75. We trimmed that at $162. Remember, there's a difference between closed and trimmed. Shopify was closed. Everything else was just trimmed. I love these companies. I like these stocks. But when we've got these gigantic returns, you've got to be prudent. You've got to take that profit and you got to tuck it away. And tuck it away is what we did. I added some money to bonds with Jeffrey Gunlock over there at Double Line. I had some money with Mark Bashallo over at Manning & Napier High Yield Bond Fund. And for all the competitors listening in to the podcast here, it's a great fund. It's the number one fund in the country, but unfortunately, you can't buy it right now. We have an exception to still use it with Mark and the company, but it's a great fund, paying 8.5%. And the other thing we did is we added some more to the managed future strategy because I want a little bit more of protection for the unexpected because I just don't trust the environment. I think the market can go higher. I don't think a recession is imminent. Nothing along those lines. Nothing screaming that to me at all in any way, shape, or form. But I do believe we've done very well. The market is very expensive. Look, I was listening to David Tepper this week. This dude, he is a pro, right? He is just a really top dog investor in the world. He owns the Carolina Panthers. Guy's a really sharp guy. Listening to him talk this week, and I was so happy to hear what he said. He said, look, with the Fed cutting, you've got to think that maybe things are going to continue to be constructive, but it is very uncomfortable because things are very expensive. Nothing is cheap. That echoes my sentiments. That's exactly how I'm feeling. So what we're doing, what we're migrating to is really moving the portfolios to all weather portfolios that are going to handle, in my opinion, anything that can be thrown at us. Any curveballs that come out of left field. Am I mixing analogies? I am. Any curveballs that are thrown at us, anything that comes from left field. Let's separate the analogies, David. Let's not put them all together. Just trying to get these portfolios so they can withstand anything that might come because we just can't load up on U.S. market right now. I think it's maybe a more dangerous thing to do. We still have plenty of exposure. We've got exposure to great stocks. If the market rips higher, we're going to make plenty of money. Are we going to make as much as we made this year? Maybe not. But I'm okay with that. We also have good foreign exposure. If the U.S. dollar continues to be weak, and maybe it will with the Fed cutting rates, hey, foreign stocks should continue to do well. We still have our gold exposure. We trimmed it a couple of weeks ago, but we still have it. We just got plenty of exposures to things that should do well if the market wants to go higher. But we also have some nice defensive plays with a bond space, and we've got the managed futures, which really act independently when things go awry like they did in 2022. When you got inflation running out of control, bonds, stocks, everything taking a hit. So that's what we're doing. I know it's a lot to cover, but there's a lot going on, and you're going to see a lot of activity coming in on your portfolios. I'm sorry it's been a couple of long weeks. I think that next week we'll get back to that 10 minutes or less. But look, thanks for hanging with us, tuning in, and thanks for giving us so much support out there. It means the world to us. Thank you so much, everybody. So between now and next meetings, you're thinking about your future, long-term goals, all the things you want to do with you and your money. Maybe it's buy that pool heater, Christina, so your family can kind of use that pool a little bit longer. You can force summer to last just a few more weeks longer. Hey, maybe it is buy that second house. We got someone working on that. Maybe it's retire a little early. Lots of folks trying to do that right now. You know what your goals are. Don't just think about it. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.